Hello, everyone. Welcome to the yet another webinar with us with our special GHRC member, the guest Dr. Tania. It's going to be an amazing session. Make sure that you stay until then, take maximum notes, ask a lot of questions. Before we move into the session and the webinar, let me introduce myself. I'm Akshay here. I'm newly joined as the sales and the marketing for the global HR community and the Singularity University as well, like the events. I would love to take a few minutes and tell you what is GHRC all about. It's a global HR community. It is the next gen AI-enabled digital platform for basically for people managers, business executives, HR professionals, entrepreneurs, and students, academicians to promote Excel through like people's and organization. And GHRC is popularly founded by like three founders like Nathan, who is ex-CHRO, Deloitte India, Shrikant, sir, CHRO and global head of EY and delivery, and Ramesh Ranjan, who is also the CHRO. In a span of like 1 year, we had around more than 2,760 people and enlisted from Britannica, Machani Group, and lot more companies. And today we have also got like India's 5,000 top MSME awards. GHRC also was been on the top 10 HR communities in the world by LinkedIn. We are proud to have right now over 8,415 followers on LinkedIn. On this platform, the main principle is all about like discover, connect, learn, and grow, right? And Discover is all about like there are over 50 plus assessment tests, cutting edge knowledge, so that one can understand what are we really best at and we can focus on those. And Connect is like there are a lot of professionals whom you can connect, have meaningful conversation, relationship building and everything. And Learning, there are like over 150,000 courses with 25 curated courses training on 1,800 plus skills. And Grow is all about accelerating your growth in job board, gamification features, and every month, whoever participates the most, they can win the gifts, all those things. And Contribute is all about like sharing, mentoring, or knowledge sharing, and everything. One can do it. And our statistics in the last year, we have around 3,099 members, around 4,100 people, 59 director listing, 20 groups, three white label projects, and so on. And we offer various annual memberships customized to your profile, and we'll be glad to assist you in the enrollment of GHRC for all the new members who want to become part of it. And thank you once again for everyone's attention. Let's move on to like today's program. And yeah, thank you so much everyone for participating, joining, taking your super valuable time. Have a phenomenal Saturday. Thank you. Over to you, Dr. Tanya.
Uh, can I?
Yeah, sure, sure. Oh, yeah,
Yeah.
with it.
Tanya, I'll just give a formal introduction
Sure.
of you and then we can go ahead.
Yeah.
Yeah, so a warm welcome to all of you for the day one of GHRC's Financial Wellness Series in collaboration with Novayas Arta. We are excited to have all of you here for what promises to be a truly transformative experience. Because yes, you can take charge of your finances in just 1 hour a week. So, today's session is all about building a strong financial foundation, covering the essentials of budgeting, saving, investing, and setting smart financial goals. And to guide us through this journey, we are honored to have with us Dr. Tania Ahuja, founder and CEO of Novayas LLC and Novayas Analyst India Private Limited, SEBI-registered investment advisor. Her mission is to democratize access to financial well-being one person at a time. So, with a PhD in finance from NYU Stern School and a powerful career in global finance and risk analytics, Tanya brings not only deep expertise but also a passion for helping individuals make confident and informed money decisions. So, let's get started on your journey to financial freedom. Over to you, Tanya. You were on mute.
Great. Thank you so much, Ritika and Akshay and GHRC for giving me this opportunity. I'm really excited to be here and meet all, all these HR. I love the the idea of we, that means for well-being. Well-being is important for to be highly productive. If you are stressed about anything, and finance is one of the causes of stress, it becomes hard to be productive at work. So I'm quite excited to be here and share what we have built. Um, I would like to bring your attention to the fact that we are SEBI-registered RIA. What that means is we have a fiduciary duty to put the interests of our client first. So we are not a brokerage. We don't sell any products for commission. So we have no conflicts of interest with our clients. In the US, as I brought this up earlier, there's a population of 30 crore people, but there are 270,000 RIAs like us. But in India, with 144 crores population, there's only 900 RIAs. So most of the financial providers you meet, or the CAs, they are selling products. They're not fiduciaries. They're not on your side. They're not mandated to be on your side. They are bankers, they're brokers, they're mutual fund distributor agents, and or insurance distributor agents. So imagine if you want to buy a suit and you're not clear what that suit is, right? And you go shopping alone. Then the suit that you're going to land up buying is most likely going to be from a store that had the word sales written in the window. So then you'll go in, and it's probably the suit that is sold to you by the best salesman, right? That you meet. And it probably is not going to be the suit you really needed. And the next morning, you're going to wake up wishing you had not bought it. But if you thought about it first, you thought about what kind of suit what you needed it for, and then you put a plan and you asked around as to what is the best store to get that right suit. And if you took a friend with you, then you're most likely going to buy the suit that you actually needed. And then the next day, when you woke up, you would be happy with that purchase, right? Because it was the right suit. So that's what our app is. Novais Artha is a financial planning tool. It helps you put a plan in place for your finances so that it then you can invest for that plan, and that way you will never run out of cash for things that you really care about, that you value most, like your family vacations, like your kids' education, weddings, your retirement. And so this way you can live a stress-free life and be confident that your money is going to be working to give you a secure future. Okay. So first, a little bit about me. I think you already heard. I have a PhD in finance from NYU Stern School of Business, and I'm on the board of directors of Stern. I've worked in over a decade in senior roles at Citigroup Investment Bank in New York, where I lived for 35 years. And on my trips to India, I noticed that consumerism is increasing with global brands and their playbook of tricks and sensory marketing and parasite placement. So people are buying more than they need. And at the same time, you have loan providers that are giving people EMIs, payday loans, credit cards, and over 70% of people do not know how to manage these products. And it's leading in America, it leads people into financial stress and debt traps. And I've seen in India, 1% of residents, New York City residents, are actually are homeless, brought on by mental health caused by financial stress. So I really want to help before it gets too late. And I believe everyone can create wealth without huge sums of money and or taking on debt. And I believe that you only need your goals, you need a plan, and you need discipline. And that's what we created No Bias, to give everyone access to financial planning, to help them stay disciplined and achieve their goals without stress. Okay. So what is financial well-being? Is the first question. Financial well-being is freedom from financial stress. It is when you work hard, you go from working hard for your money to your money working hard for you, right? And the first step is financial literacy. It's knowing money basics, like what are the various pillars of money? How do you budget? How do you save? How do you invest? How do you use all these financial products? And then the second step is financial planning. So we earn primarily to cater to our needs and wants today. But what about your future? After all, the future is very uncertain. And after a certain age, we are going to be leaning towards retirement when our salary and income completely stop. So, in order to make sure that's not just today's needs which are taken care of, but also our future needs, there are 4 simple steps we can take. Okay, so today we're going to learn more about half of this, the 4 pillars of budgeting, saving, investing, and debt management. And we're going to learn how to make a financial plan to achieve both our current and our future goals. And protecting your plan is your insurances, your emergency fund, and to take care of things that you cannot plan for, right? These are life's uncertainties. That's life. So make sure you have a plan for things that you plan, and things you don't plan for, you get insurance, and you have an emergency fund. Okay, so step 1 is saving. You have to start saving prudently if you haven't already. If you're struggling to be able to save anything from your monthly income, then, or if you're spending everything, then you have to focus on maintaining a budget, right? And a good budget is going to help you plan your money just the way you plan your day. You have a fixed amount of time, 24 hours in a day, you have a certain amount of money for today and the future. And this will help you reduce unnecessary spending, like online impulse shopping, that eats into your savings. Sticking to a planned expenses means you stick to your savings so you can reach your goals. So let's see how to budget. We're going to show you how you can budget with the Nobias page. You can track your budget. Okay, so on this My Money page, you can track your budget. First, you allocate your monthly income to your needs, your wants, and your savings. And you can adjust these sliders by simply moving these sliders, right? You can adjust if you want to save more or less. Next, in your needs, you add your categories, right? Your essentials like rent, utilities, groceries, etc. And in your wants, you add your categories these are not essential, but that's what you enjoy and makes life fun, right? So food. So now we're going to add a clothing category. So pick a clothes. Second, let me just pause it. So we're going to add a clothing category. Let's add budget category. And here we save, you have the clothes, you have 5,000 rupees left. There's been no expenses yet. So now you have to go to your transactions and add your all your transactions. And now you see there's 1,200 left. So when you categorize your transactions, automatically your spend shows up. And this way, before you go out, you can quickly take a look to see if you have any budget to save. So how do you budget? Again, allocate to a 50-30-20 rule, create your budget, like your clothing budget, categorize, set up your budget limit, like I did. I set up a 5,000 rupee limit. And then at the end of the month, you can analyze your spend and figure out how can you stick to your plan if you have not been able to, right? So maybe you want to perhaps you can figure out the other subscriptions you're not using. Maybe you can cook at home, shop during sales, figure out what you need to do. But this way, if you using this tool, you'll be able to pinpoint exactly where you're having trouble saving, right? Which one of the many categories are you breaking to? And you get alerts. We put an exclamation point, so like in this case, I'm spending too much on utilities, for example. Okay. Remember, it's a good budget means you know where your money is and you never have to wonder where it went. This is an important tip. When you get your salary, transfer the amount that you plan to save, because now you have a planned expenditure. So if you have a planned expenditure, then you really have a planned savings, right? So whatever you plan to save, move it into your savings account. So not to leave only what you plan to spend in your expense account. quick question. Which of these is something you should do before spending money? Should you close your eyes? Should you borrow from a friend? Should you check your budget, or should you flip a coin? Anybody want to hazard a guess?
We need to create our budget.
Exactly. Thank you. The correct answer, check your budget before you go and spend, right?
Before budget, there should be a planning, I think. Financial planning.
But a budget is part of the plan.
Yeah.
It's the
Budget
first
will come secondary. No? First we will
exactly.
what we want.
Yes.
Thank you.
Thank you. So, but savings is not going to be enough. We also need to spend. We need to spend. We need to invest, right? We need to invest our savings wisely. But what do you mean by what does it mean to say save and invest wisely? So in truth, our money is going to get eaten away by inflation all the time. So what is inflation? Inflation is when the value of money reduces with time. If you assume 6% inflation, then 1,000 rupees today is going to be worth only 940 rupees 1 year later. And you can only buy that much less with it. And in 10 years, your 1,000 rupees is going to be worth 550 rupees. In fact, inflation was higher than 6% last year. Food inflation was 7.5%. Rental inflation was 15% in Mumbai. And education inflation was 12%. So in 30 years, our monthly expenses are going to be 10 times what they are today. So how can we be one step ahead? The answer is we use the magic of compounding. So imagine you have a magic rupee, right? This magic rupee doubles every day. So on day 1, it's 1 rupee. Day 2, it's 2 rupees. Day 5, it's 16 rupees. Day 10, it is 512 rupees. Day 20, it is 5 lakhs. And day 30, it is 53 crores. So basically, it goes from being 1 rupee to 53 crores at the end of the month. Of course, I'm sorry to say there's no magic rupee, but let's say our money doubles every 5 years. Okay, so on day 1, so if you put 1 lakh at the age of 25, that 1 lakh will be 2 lakhs at the age of 30, right? 4 lakhs at the age of 35, 8 lakhs at the age of 40, 16 lakhs at 45, 32 at 50, 64 at 55, and 1.3 crores at 60. Now you might ask, is this doubling every 5 years possible? And the answer is yes. This is not unreasonable. The Nifty 50, that's investing in the top 50 companies in India, has returned a little over 17% last year, the last 5 years. So at 15%, your money doubles every 5 years. So clearly it is possible, right? To double your money every 5 years. So now that you know that you can do this, but you might say, I don't have a lakh at age 25. What to invest as a lump sum, right? So how about investing 1,000 as an SIP, monthly SIP, just 1,000. So at the end, if you invest 1,000 at the age of 25, every month, you will have invested a total of 4.2 lakhs, but you can expect to get 1.5 crores at the age of 60. And if you start at 35, let's go, you will only have 44 lakhs at age 60 after investing 3 lakhs. Okay, so a little bit less than 4 lakhs, but still for a lot less, right, at 60. And if you start at 45, you will get 11 lakhs after investing almost 2 lakhs. Okay, so clearly you need to give your money time to compound. Okay, so how much SIP do you think you're going to need if you started later, right? At 35, if you want to get that same 1.5 crores, how much do you think you should get? How much do you think you should invest? The answer is you need to invest 4,000 rupees per month, right? Not 1,000 rupees. And you will have invested 12 lakhs, not 4 lakhs to get 1.5 crores. And if you wait another 10 years, you start at 45, you'll be investing 14,000, which is 25 lakhs instead of just 4 lakhs. And 14,000 is a lot more than 1,000. So your 45-year-old self will say thank you to your 25-year-old self if you put aside 1,000 rupees every month. Okay. So the point of this whole thing is invest small, but invest early. And all of this, I just want to point out, all of these calculations are you assuming that you invested in direct plans. If you made a mistake or you did not talk to an RIA, but instead went and spoke to all the salesmen, then they're going to put you in regular plans. In regular plans, you will only get 1 crore because half a crore goes in commissions. Okay. Okay. So let's go on to the next thing. But this compounding, which is it's a magical thing, it can be used against us. And it is used against you by banks and loan providers like early wage access, payday loans, EMIs, and it leads people into debt traps because just like it makes you very, very rich at the end of 60 years, it could also make you very, very poor even earlier. So debt trap is when your loans, credit card bills, and your EMIs are growing faster than you can repay them. And it starts really innocently. It starts by borrowing a little bit, but then because of high interest rates, especially on loans, on personal loans and on credit cards, they cause you to miss a payment and it piles on more debt. And then soon you're taking loans to pay off old loans, right? And this is the cycle. And this cycle gets harder to escape each month. And the only way out is to budget and spend wisely, borrow responsibly, and as soon as you can, pay off the full balance on any personal loans or credit cards, because these are the very high interest rate products that actually cause a real problem. But all debt is not bad. Okay, loans can be used right for growth. It helps you build assets, boost your earnings, and if you borrow to invest in yourself, whether you're funding your education to upskill or buying a car or a two-wheeler that gets you to a job that earns more money, any kind of borrowing to create more income, like a business loan, are all good examples of good loans. Okay, bad loans, as I said, are credit card loans, personal loans for vacations, EMIs on clothes and household items. Okay, now here are common mistakes that people make. On the case of credit cards, they think that paying the minimum payment due on the payment due date is fine, and it's not. If you have a 20,000 rupee balance, then 3% monthly interest, which is what credit cards charge, turns into 28,000 in a year and more if you keep spending. This is how many people do fall into the debt trap, paying interest on interest month after month. So it's important to know, if you don't pay off your credit card bill in full, you get charged daily on the entire amount from the transaction date, not the unpaid portion. And new purchases start attracting interest immediately until the full balance is cleared. So until you clear the full balance, they will treat you as an unpaid balance person and will charge on the full balance. Okay, they write this in small print, but it's important to understand it. Another common mistake people make is when they're choosing a loan, they're trying to choose between a loan from one provider or another. They might, by mistake, they look at the interest rate and they choose a loan that is on a fixed balance because it happens to be a smaller interest rate than on a reducing balance. And this is important because paying, I mean, on a reducing balance, you save a lot more money, right, than on a fixed balance. So this is something that is that you really need to watch out for. And because I'll give you an example. So if you took a 1 lakh loan, then and you a 1 lakh loan at 12% interest over 1 year on a reducing balance, the amount of interest you would pay is 12,000 rupees. But on a reducing balance, it is just 6,000 rupees. So it is effectively double. So reducing balance makes you pay double the amount on a fixed balance compared to fixed. So always look at reducing balances. Make sure that the loan is on a reducing balance and you're not paying on the fixed balance, because that way, even though you might pay off some of the balances, your interest is still going to be the same because it's fixed. Okay. Next is the impact of debt on your credit score. A lot of people seem to think that, oh, if I don't take on a loan, then I won't have a credit score. And that is not true. um, having having a credit card is a great thing because it gives you credit until for a fixed amount of time, but you need to pay it off in full. Having a loan because you need it to provide something better in the future, or a home, or something income producing, all good reasons. And it's true that when you do that, you do have a credit score. But if you do not pay off your balance in full, your credit score goes down. If you do not make your payments on time, your credit score goes down. So, and why is that really, really important that your credit score is a good score? Is because when you really need a loan, a large loan, to buy something, you will be given a higher interest rate than a person with a good credit score. Even though you are maybe the same age, you may be the same salary, earning the same salary, the interest rate that they will give you will be a much higher interest rate. So having a good credit score is important, but not but taking on debt, which is always dangerous, um, is something that you shouldn't do just to start getting a credit score, right? Debt is to be handled very, very carefully. Okay, so let's go on to the next. Now we're going to play a quick quiz game.
Tanya ma'am, sorry to
Yeah.
interrupt. Can you please explain the concept of fixed and reducing balance again?
Absolutely.
Thank you.
So a fixed balance. So when you borrow a loan, right? You but there are two kinds of loans that the loan provider can give you, and they will give you different interest rates. Like they might say you can get 7.5%. One loan would be 7.5%. But if you don't check that 7.5% is it on fixed or reducing, it's. And then there's another one that says 9%. Is that fixed reducing? If you check closely, you might find that 7.5% is on a fixed balance and the 9% is on a reducing balance. But if you look at just 7.5 and 9, you're going to say, I'm going to take the one with the lower interest rate, the 7.5. But when you actually multiply it out, you will find, so you need to actually calculate how much interest are you going to be paying on the 7.5% fixed balance versus reducing balance. So fixed balance means that if you've taken a 5 lakh loan, and even though you're paying amounts like say a lakh a year, say you've taken a 5-year loan, little over a lakh plus interest, you're still paying after 4 years, the interest is of 7.5% is still being calculated on the original 5 lakhs, even though you've already paid off 4 lakhs and you only have 1 lakh outstanding, but you're still calculating the interest is on 7.5 times the 5. That's the fixed balance. The balance is not reducing. On a reducing balance, which is what you need to make sure that's what, because read the small print. You in the beginning, that 9% will be on the 5 lakhs, and then after a year you have 4 lakhs outstanding. It's now going to be 9% of 4 lakhs, then 9% on 3 lakhs, and 9% on 1 lakh. Is that clear?
Yeah, thank you so much. Is it similar to the concept of floating interest rate by any
No,
chance? No.
no. That's different. So in the case of floating and fixed interest rate, that is like when the 7.5% and the 9% I mentioned, those are fixed rates, right? They also have something called floating rates. What that means is that when interest rates go up, your interest rate can be going up. When interest rates go down, your interest rate will go down. As a rule, it's always preferable to stick with fixed interest rates because nobody knows what's going to happen in the future. This is much easier. You can budget. You know exactly how much interest every month you're going to be paying. So as much as possible, always go for fixed interest rates on a reducing balance. Sorry,
Perfect.
that's
Thank you.
finance for
Thank you
you,
so much.
right?
Yeah, thank you so much.
Just make it unnecessarily difficult, but it's a way that they can make money, right? Okay, so I was going to play a quick game called Myth or Fact. Quick question one. How many of you think this statement is a myth or a fact? You can start investing with as little as 100 rupees.
It's a fact.
Good job. If I have a t-shirt, I would give it to you. The answer is yes. With SIP, you can start investing as little as 100 rupees per month. Okay. Myth or fact? Paying the minimum amount due on the payment due date is good for your credit score and wallet. After all, that's what credit card is for. Myth or
Yes.
fact?
Myth.
Thank you. You need to pay your credit card in full to avoid interest charges over 36% per year and maintain a healthy credit score in full balance, not the minimum payment due. When it comes to investing in mutual funds, both plans, regular and direct, yield the same returns. Myth or fact?
Myth.
Correct. Myth. Direct plans yield higher returns because there's no intermediary, no banker, no agent taking distribution commissions. Myth or fact? In order to make profits from the stock market, one has to time the market. Myth or fact?
This is fact.
Sorry?
You have to time the market means you have to wait for some time or what do you mean?
No. Time the market means you have to figure out when is the market going up and
No, yes.
get in time just before the market goes up and get out just before the market goes down.
That's a myth.
It's a myth.
Good job. Samit, it's not time, it's time in the market is more important than timing the market. Long-term investing yields much better returns. And compounding, like we talked about, works better when investments are held for long periods of time. It's really interesting fact is we looked at the data for Nifty 50 over the last 35 years. If you took your money out and missed 10 days, 10 big days, just the 10 big days of market going up, 10 days out of 35 years, you will have lost 70% of returns. So if you would have gotten 12% over 35 years, compounding, of course, that you would only get 9%. So you would get something that's same as putting your money in a bank. No point in investing. If you get nervous when the market goes down, take it out, and then you miss the jump that comes soon after markets go down. So the best thing is just leave it there and let it compound over time. Okay? Very important point.
I have one question in the
Yes,
previous,
sure.
sorry if I may. What is how would you define this time? A long time? I mean, for me, it's very subjective. So, I mean, from your perspective, what long time is probably the best time to stay invested in?
Very good point. Very good question. And when we're talking about the Nifty 50, that's an equity. Equities, you should plan to hold it for 10 years or longer. Anything less than 10 years, if you have a plan in mind, like you want to buy a car in 5 years, you cannot be investing in equity for not all of your money. Little bit, some portion of your money you can put in equity, but not all of it. Now, if your retirement is in a long time, then a larger portion can be in equity. And you hold whatever it is you're holding in equity, you just keep holding it until and that's all part of the planning, which we shall show you over this day and the next day, right? How much to keep in what kind of asset and how long to keep it. So at every point in time, you have to keep on balancing. So you only keep in equity the money that needs to be compounded for long periods of time. Okay?
Perfect. Thank you.
Okay. So next one, myth or fact. Purchasing insurance cum investment products like ULIPs. Are they a good investment or a bad investment? So,
Good.
okay, so this is a myth. So insurance products, great. Term insurance, great. But ULIPs, which is a combination product with an endowment plan, these are not good for you. They're very bad investments because they what they do is they tell you that, oh, if you get a ULIP or this LIC policy endowment plan, you will get your premium back, right? Your term insurance premium. But if you compare that product with a term insurance where you just pay a fixed amount for your insurance and the remaining amount, the remaining premium, is used for investment separately, you will get so much higher returns and no commissions. This is a high cost, high commission, poor flexibility product. It is even the government, SEBI, has written about it, has told people, please do not get these combo plans. Figure out break it up and see what returns are you actually getting, and is it worth it, right? They even sometimes lower than what you get in a bank, leaving your money in a bank and just paying a small premium for your term insurance. Okay, so what can we invest in is the next question, right? The answer is there are different kinds of asset classes, right, that you need. We just discussed keeping your money in safe assets like cash and bank FDs is not going to give you enough returns to cover inflation, right? So where should you invest? The answer is some money in equity, some in gold, and some in long maturity debt instruments, right? So because this is the only way that you are going to be able to beat inflation and provide for your goals that are more than just immediate, right? So we're going to go into more details on all of these three asset classes in the next workshop. But now that you understand the money basics of budgeting, saving, inflation, compounding, and investing, we can go into a little more. I'm sorry, I seem to have a. It's got stuck.
The last transition just spoke about the crypto also as one of the modes of investment, Tanya.
Yes, but we're not going to go into crypto. I mean, those asset classes like real estate, etc., we're not going to be going into because these are alternate investments that you really need to be much more sophisticated and make sure that you have a plan that first covers all your needs in a way, and then only with extra that you're trying to gamble, you could say, you go into or use more sophisticated methods. Okay, so they are at the end of the day more risky, much more riskier than gold and equity, and you really have to understand the nuances. Okay, so now that we understood these basics of budgeting, saving, investing, compounding, we're going to go on to step 2, which is making a plan to achieve your SMART goals, a plan to manage your debt, if you have any, and a plan, protect your plan with insurance, right? So whether your goal is to build an emergency fund, a safer retirement, pay off debt, or save for your children's education or down payment on a home, having a clear objective in mind helps you stay motivated, right? So you can avoid buying something that you don't really need. And this way, you know that you can get the things you really, really want, right? More importantly, it helps you make the right investing decisions, because because we need to invest based on the time of those goals. So we need to know and that's what we're going to show you, how to create a SMART goal. And lastly, it gives you a sense of accomplishment when you have accomplished this goal. So when setting financial goals, it's really important to make sure that define them in this way, that you need to be specific, measurable, achievable, relevant, and time-bound. SMART, right? So let's take an example. Say I'm saving for a trip, right? You need to be specific. You need to say, I'm saving for a 4-day Goa vacation. Measurable means, instead of, you say, how much are you going to actually be able to save for this vacation? It's 50,000 rupees, right? And achievable, I want to save 50,000 rupees for a Goa vacation by saving 1,000 rupees per month. So now you know exactly what the goal amount is, 50,000. That's what you're going to be spending on your Goa vacation. And you got 4 days in Goa, and you know that you are going to achieve it because you do have 1,000 rupees to be able to save every month. Relevant, you have to think about it. Is this goal relevant to you, for your finances, for all your other goals? How important it is? And it is important because it's your honeymoon. So no question. Time bound. What is the time when you're going to be doing this? And in this example, so this is what's called a SMART goal, where you know that you're saving 50,000 rupees for a Goa honeymoon by saving 1,000 rupees per month for 3 years. And you can see a picture of the app on your right, and that is how we make sure that you put in your SMART goal. Everything.
Sorry, I don't understand.
Oh. It turned on Siri by mistake. I didn't know how to turn it off. Okay, let's hope. So here, let's play this one. Here's how you can do it in the app. This is the My Money page, and here you're seeing all your goals, right? Your My Goals card shows all your goals coming up this year and the goals in the future. 2 goals, your emergency fund and your retirement, are automatically going to be added. Now we're going to add a new goal. So you click Manage Goals. And here you can see a summary of all your existing goals. So let's add that vacation, right? Here's a vacation. And you click Done. Now let's make it specific. Let's change the name to Goa Vacation. Okay. Now let's make it measurable. Let's fill in the amount for your Goa vacation. And now we're going to move this bar to see how much, how we're going to make it time bound and make it achievable. As you increase that time, it gives you the SIP goes up or down. And okay, here we go, 3 years and 1,000 rupees. Now we know that this is achievable. So you set your goal, your SMART goal. And here you can see it's been added. Now you have it here with all your goals, but maybe you want to prioritize it. So you can move these cards up and down. It's just by dragging them to adjust the priority. And automatically the SIP will update based on the highest priority goal. Okay. So remember, your goals need to be easily classified in terms of 2 criteria. First of all, we need it to be segregated, because in order to invest, we need to be able to segregate these goals into immediate goals, short-term goals, medium-term goals, and long-term goals. Okay. And second, they need to be categorized and prioritized. By categorized, we mean, are we going to be investing in this goal from your needs budget, because it's a future needs goal, or your wants budget for a future wants goal, or your savings budget for your future financial goals, okay, like your emergency fund, retirement, or any other financial goal that you have, right? So we have limited resources and we're not going to be able to fund all our goals. So that's why prioritizing your goal is very important so that you can invest for them accordingly. Assigning this priority is only up to you. Nobody else can decide the priority of goals. Okay. Now let's see how to plan to manage the loans that you might have. The three methods that you can pay off your debt. The first is called the snowball method, where we pay as much as possible on the minimum amount due for all the loans except the smallest. The smallest loan you pay off as much of money that you have. Try to pay off about 4 times the minimum amount. And on the other loans, the minimum amount, so you don't get in trouble. And you repeat this until all the loans are paid off. The next is a smarter method, which is the avalanche method. Here you pay as much as possible on the highest interest rate loans, but make sure to pay the minimum amount due on the others. And then you repeat this until all the debts are paid off. So you pay first the highest interest rate that you're paying. Mostly they're going to be credit card loans and personal loans. Then you go on to your or other loans, right? Slowly, one by one. The last is the blizzard method. So a lot of people find it very hard to do the highest interest rate debt because that is it may be a very large amount that you've accumulated. So, but maybe there's a tiny loan somewhere that it'll make easier to accomplish. So some people do the blizzard where they pay as much as possible on the smallest debt because it's achievable easily, fast, and makes them feel good. And then you go on to doing the more harder, higher interest rate. So they keep going back and forth just to keep the momentum going. Anybody have any questions on this? We can show you a demo of how to do it. I'm going to let it play because it's fast. In this video, we will show you how you can manage your debt, both loans and credit card debt, in the Novice Artha app. First, add all your loans in liabilities to get an accurate picture of your net worth and your financial health. So let's put, for example, car loan. How much EMI do you think it would be? So you can see your loan here. Okay, next on transactions, identify any EMI transactions and set them as recurring. Okay, there we go, the HDFC loan. Just click on this and you have it's categorized in wants, needs, and payments. Okay, thank you. And also it's a recurring payment and it's monthly on the 10th of every month. Confirm. And then, yes, click that you want a reminder. You can write over here, make a note of this is a car loan. Jeez, save. Okay. Now here you can, if you go back to your My Money page, you can see you should be able to track all your loans, your loan EMIs in your managed budget. Let's go look. So there you have 10K and you've got a budget limit of 10K. Okay, now after you're studying your loans and considering the three methods, the snowball, the avalanche, and maybe the blizzard, if you decide to pay back your car loan early, the same car loan, suppose now here you have a 5 lakh outstanding balance, and supposing there's 6 years left to repay it. So you see how much money you can you can spare in other needs. So you have 19,000 rupees in other needs and 26,000 rupees in other wants. So you can actually put like almost 40,000, over 40,000 rupees towards this car loan. So the way you do it is you head over to the goals section. Goals. Okay, and let's add a goal as showed you earlier. Add new goal, and it's going to credit card debt. Okay, gonna put the amount of we're gonna try and pay off half the loan. Okay, so it's 2.5 lakhs. Are you gonna make that 2.5 lakhs? And you're going to try to do it. Oh, you can do it in 1 year with 20,000 rupees. Prepay or loan. Okay. You set your goal. And so in 1 year, you're going to be putting aside, and you confirm your goal. Okay, cool. Since pay loan, okay, it's prepay, some high priority, we're going to move it above. Now we're going to look at prepaying your credit card debt. The best way to prepay your credit card debt is by paying as much as you can every month. You can do this in the budgeting section. Okay, so here you have a budgeting section. Suppose you want to pay off your credit card balance. And again, you determine how much money you want. Now you don't have anything in other. In the budget, you can now see prepay car loan has showed up as a goal, and all the money that you had in other is now come into that goal. Okay, credit card. So, okay, so you see you have 0 in other needs, but you have some 26,000 in other wants. So let's move the slider so you get a little more money. Let's pay the credit card bill by 5,000 a month. So let's go there. Let's keep it. And 7 in other. So now let's add a budget category. And we're going to credit card debt, credit card minimum due. Okay, so credit card, let's put 5,000 here. Okay. Add. And now you can see credit card minimum due. You have 5,000 rupee limit. And now you need to transfer 5,000 rupees over. And when you see it, you can put it to this budget category. Update. All months. In this video, we will show you. Okay, great. So does anybody have any questions? So can we go on because we are running short time?
So this app we can all download, the Nobia's
Yes,
app. Yeah.
absolutely. You can just download the app and that's what the app does for you. It helps you put your plan, every component of the plan, the budgeting, the goals, as you saw, and then we're going to show you how you're going to be able to invest for the goals. It takes you through the entire journey, but also you need to know the nice thing about it is in addition to just like I'm telling you what you need to do, all of this learning is also already embedded in the app. There's everywhere you'll see these I buttons. You see this little I button. So when you click on that I button, it will give you the similar recording. It'll give you these demos. It'll give you reading blogs, videos, everything that you need to totally understand that component and how to use it. Okay.
Wonderful.
Great. Let's go to the next slide. So next thing, now that we have a plan, but before we can start investing, you need to protect our plan. And you do this with insurance and of course, emergency fund, but insurances are the best line of defense against unexpected, unplanned events that happen in life, right? There are 3 kinds of protection you can set up: health insurance, life insurance, and an emergency fund. Everyone should have health insurance. Everyone should take adequate health insurance to cover yourself and all of your dependents. And you can do this with a mix of base and top-up policies that you can take to increase your cover and decrease your premium, right? Important, lock in lower premiums when you're younger and healthier. So, but health insurance is a must for everyone in the family. Next is life insurance. It's necessary if you have dependents. If you don't have dependents, it's not necessary. But the reason it's important is that this way, they can still get what you have planned for, because you put together a plan that requires a certain amount of money and, for maybe their education, maybe their wedding. This way they can get it even if you're not there, right? Again, like we discussed in the myth and fact, avoid combo plans like LIC, endowment plans because they end up providing low returns and high expenses and commissions. Okay. Emergency fund. Everyone needs an emergency fund. It needs to cover at least 6 months of needs. And we do this automatically. You will already have a retirement fund and an emergency fund included. It should at least cover 6 months of, like I said, needs like rent, bills, food, EMIs, medical education. It's a good idea to keep it in a liquid fund so that you can access it in a hurry, okay, should you need it. A quick recap. You now know what financial well-being is. You started your journey and on understanding the basics, key concepts like inflation, compounding, debt, how you use compounding for you, not against you, but debt, budgeting, assets. We're going to go into, and you've understood how to make a SMART goal. Without a SMART goal, without your insurances in place, you can't start investing. Okay, so for the next week, please just have that set up. And then we're going to go into more detail on, this is the idea of the financial plan that you're going to learn. You've already got the first 4 steps, which is plan your budget, allocate your income to your budget, set aside your savings, move savings out of the expense account, then track your spending so you can stick to your budget plan, set up your SMART goals, prioritize them. Point 5 and 6 is those 2 steps we're going to go on next week. And of course, step 7 is set up your insurance to protect your plan. So next week, we're going to help you come up with an investment allocation plan for these goals. Now that you have the goals, we're going to explain to you what risk profile means, what risks, explain all these various asset classes and the risk embedded in each of them, and we're going to put together an investment allocation plan so that you can invest and set up your SIP according to your plan and track and monitor your investments to make sure that you are on track. Okay. So this is the, quick reminders, daily activities. When you download the app there's a lot of learning content. You'll see that quiz of the day, play them. There is a lot of news based on whatever portfolio you already have. Because if you have any mutual funds, you're basically already invested in some companies, right? So this way, read about the news on the company. That's going to improve your financial literacy. Spend 10 minutes a day reading the news, learning a new word. And at the end and most important, categorize your transaction into budget categories. This is a habit that I would really like to see anybody on the app doing. Every day, budget categorize your budget transactions, and before you spend, check your budget to make sure that you have money left in that category that you're about to spend in. Every month, you're going to be at the end of the month looking at the last month. Was everything okay? Do you need to change your budget a little bit? Do you maybe need to make adjustments in your behavior for next month so that you stick to your budget? And also, after next week, when we teach you about how to research stocks and mutual funds, we're going to show you how to do that. Put in your watch list, research, etc. And quarterly, you're going to be rebalancing your portfolio, and we'll teach you how to do that also. When you get on the app, you're going to have to do a KYC and answer some questions about how you handle risk. It's very, very important that because understand, for us to tell you how much you need to invest, we need to know what is your risk capacity and your risk tolerance. And this is at the end of these 10, 12 questions, we'll also tell you what your profile is and how we're going to be helping you invest based on that and based on your goals. Okay. Providing us with accurate and detailed data is paramount, because the robot RIA or me, we cannot help you unless we have this information. So it's really important, and just bear in mind that all of this is completely confidential, okay, and private and very, very safe. we have all the state-of-the-art protections in place. If you work for a company, and if the company has told you about this, in this case is GHRC has told you about this, I want you to understand that all the employer is doing is, putting up this literacy session and encouraging you to take advantage of the app to be able to put it into practice. But at the end of the day, the right and responsibility is yours. Okay, so nobody else is going to be your employer cannot see anything. Your employer is not going to be able to see what your goals are, what are you, how you're doing. So every decision that is being made is completely yours. The app is going to give you timely financial advice based on the data that is in the app, and of course your goals and your risk profile. But at the end of the day, you are responsible for executing, making sure that you're on track. You'll get a lot of alerts, a lot of reminders, but only you can actually do it. We're not going to be doing anything for you. Okay, this is very, very important to understand. Lastly, your data is not going to be shared with your employer or with any third parties as well. We don't have ads. We don't. So you're never going to get any cross-selling. Nobody's going to, like, we don't sell your data. So you're not going to, like, I think Cred, I heard, sells data. And when you get on the Cred app, you start getting calls for loans, loan offers and stuff. That does not happen. We believe that if you need a loan, we'll tell you how to go get it, what kind of loan, etc. But we're not going to let people push product, like try to sell you loans, right? We already live. So this way, the goal is to live a stress-free life and to be confident that your money is working for you to give you a secure future. So you need to have a strategic plan in place to beat inflation and make sure you don't run out of cash for things that you really care about, like your kids' education, their wedding, your home, your retirement. And post-retirement, you want to make sure that you have a consistent flow of income, even when you're not working. So that's what always remember your goals and why you're, spending this effort. There's been a lot of information out there that we've gone over today. There's going to be a lot more next week, but I think, I just want to make sure that you guys know that the app, the costing of the app subscription is 250 rupees a month, and it's 750 rupees quarterly billing. So it's billed for 3 months. But what we're going to do is we're going to have a special until June 1st for everybody here to trial it. And you'll be able to get it for 300 rupees. So 100 rupees a month, 300 rupees for 3 months. So please do download it and let us know what you think. If you're interested in, like, for some of you who are HR, and if you're interested in sharing it with others in your company, we also have a separate trial offer, which is very, very low. It's almost like free. It's 17 rupees a month. So please just reach out to us and we'll set that up for you. But that is because we're starting the conversation at the company and for the financial well-being of all the employees at the company. So for that, we open up a trial for some people in the company who are, there's always going to be a few, especially younger folks who already are using apps. So in order for them to get yet another app and try it out and let you know what they think, how does it compare to other apps out there, we make it available for almost free. So that brings us to the end. Is there any questions? Does anybody have any questions?
This app, Tanya, is SEBI registered, SEBI certified, or SEBI approved?
So we are SEBI registered.
Okay.
So anything that we do, we have to make sure it is SEBI compliant. So there's no information in there that is every single bit of information, all the education, all comes from NISM. NISM is a SEBI body that that certifies that people who are practicing have the right credentials, right? So they certify financial professionals. And so all of the education, all of the material is only NISM, nothing, we don't make things up. And everything that is in there, all the best practices are best practices, both from NISM and SEBI, and also it's, and in the US as well, and by FINRA. So the good news is worldwide, the best practices are the same.
Wonderful.
I'm sorry, I forgot. I kept my video off. I turned it off for the demo, and then after that, forgot to turn it on. Apologies. Any other questions?
Hi, Tanya. I have a question. Now, see, is financial, it was very wonderful session. Thank you so much. Now, the question is like, why is it so much big problem in the country, in India and in the world, like the financial literacy, right? Most people, even though they earn so much money, uh, at the end of the month, everything goes either in EMI, rent, this thing, that thing. Barely they survive month on month.
So you must have the answer to the question, right? After this session.
Yeah.
The reason is they don't have a plan. Like if you go shopping without a plan, right? If you don't have a plan, like I'm only going to spend this much money and this is what I actually need, you're going to land up buying things that some salesman has sold you, right? Like you'll see
We need to
sales
measure
guy.
it.
Yeah, you need to know. You need to have a plan. If you have a plan, then you know where every single rupee is planned. You know that every single rupee in your salary has a plan for it. It's a plan
Got it.
to be spent this month or a plan to be invested for the future, right? So then you're not
Yes.
going to ruin it because you've sat there and created that plan. So that's what I want everybody to do if they, between now and next week, to take the trouble to think about what are your goals and put them in and then next week we're going to go into how are you going to invest for these goals. So the idea is not to just go and set up an SIP in put 100 rupees Nifty 50 SIP. What for? For what goal? I mean, is that for your retirement? Is that, and then like, you see, oh, look, I've got enough money there. I can buy a computer. But that was not your plan. Was that your plan? Right? Then
No.
it's not, that 100 rupees is not there for your retirement. So having a plan means we're going to tell you when you've achieved enough money to buy the computer, when, and that you're on track for your retirement. So, and if you decide not, you can, of course, obviously our plans change, things happen. You can change your plan. This is all under your control. And obviously, when you change your plan, you may not be able to achieve other things, but you'll at least know. That's the whole idea. The very important part of which is really the opposite of what salesmen want. Salesmen don't want you coming saying, I want only this, because then it reduces their universe. They only have like 6, like if it's a sari, right? And you come in and you
Yes.
say, I want a pink sari. Then they'll only have 6 pink saris to show you. And you may not like any of them, and you walk out and go to the next door, right? So it's
True.
because you're very clear so what you want, right? Otherwise, if you go in there without a plan, they're going to sell you something that you don't want, but they want to sell it because they're getting a high commission.
Correct. True.
Okay?
Yeah, absolutely. Love that.
So that's what RIAs do. RIAs are all about, let's put in a plan, let's create an allocation. That's what you're going to learn next time, an investment allocation to invest for this plan. And so we're going to monitor how much, your interest, your returns. And it's very important with us, we take you to MF Central, where you can invest directly. So not regular plans, direct plans. That's another thing nobody really knows. I've spoken to folks who said to me, "Oh, I invested direct because my SBI banker put me in an SBI mutual fund, so it must be direct." No, it is not direct. that SBI banker is playing the role of a distributor and he's getting a commission, even though it's all SBI. He's being paid by SBI mutual fund to put you in that SBI mutual fund. So it's a commission. Here, you're not going to have no commissions. I don't get any commissions. All I get is that fee. So that's the other thing about RIAs. They can only be paid a fee. And our client is not the mutual fund distributor. It's not SBI. It's nobody. It's you. So your fee is the only revenue that we are going to get. Okay. Hi, Ashok. I think you're drawing. Thank you. Okay, let me see. Any chats? Any questions in the chat? These are all greetings. Any other questions?
Kamal has a question.
Hi, Kamal.
I think he's put it on the chat box. Fee or commission?
Yes.
What's the difference?
A very good point. A commission is a sales commission. A commission means that someone has sold you a product and they're being paid by the product provider, not by you. Okay. What that means is the person they're getting their revenue from is like the mutual fund. And the mutual fund is they have a relationship with the mutual fund. The mutual fund is going to encourage them to sell certain things rather than because they need more people buying a particular product. So they'll tell the person, please sell this product and you'll get more commission than if you sold the other one. So what ends up happening then is you're not their client. None of these people are your friends. No providers are your friends unless they're registered investment advisors, right? Just keep that in your mind. And so then if you're going to be working with them, you're going to have to work double hard to figure out, why are they selling me this? You have to go do your research and find out what is the commission. And the commission is the way you find out the commission is very hard to find out because nobody tells you what is the commission, what is the expenses on a direct plan and a regular plan, because they only show you regular plans. So to see the direct plan, you would have to go to a broker. So you can open any broker app and you have to say, I want to see a direct plan. And then you see the expenses on direct, see the expenses on regular. The difference is the commission that you're going to be paying. Now, fee is what I've told you, to get no bias, you have to pay 200 rupees, 250 rupees a month. That's the fee. Okay, it's a fixed, in my case, it's a fixed fee. Some RIAs, it's a percentage of amount you invest, but it's a fee. A fee is what you pay for the advice. Okay, a commission is what you pay for buying a product. That person is going to be paid the commission from the product producer. Okay. Is that clear? Fee versus commission? Kamal? Kamal?
He's on the call, but just not responding, maybe.
Okay.
Tanya ma'am, I had one question. In your myth versus fact quiz in the deck, there was something on credit card. I missed that. If you could please repeat it. What was that?
Okay. I did cover it later on as well, is because it is a common mistake lots of people make. When you get your credit card bill, it says in big letters, payment due date, like 10th of May. And then next to it says minimum payment due, big letters. And then below it says statement balance, but in smaller letters. So everybody thinks they only need to pay their minimum payment due. The answer is no. That's the myth. You need to pay the full payment. The other myth is people think that you should have a credit card because then you'll get a good credit, you have a credit score. And the answer is no, that's not true either, because if you don't make your payments if you do not pay the balance in full, if you're running a balance, that means you're in debt. Having a debt and you're not gets you a negative mark. So especially if it is more than, there are certain figures, like the number is 30%. If you have more than 30% of your income is going to service your debt, that's dangerous. So you're not considered a good creditworthy for more loans. So there's a lot of things that go into a credit score, but that's one of them.
Sure, thank you, ma'am. And since you spoke about credit score, I happened to check the CIBIL score from my
Yeah,
bank site, and they provided me with an Experian report, end to end, and every detail was there. The good thing is that it had all the information of the credit cards that I've had so far, personal and as well as corporate cards. I have
yes,
two questions in that. I saw two things. One of, there was an corporate card that I was issued in one of my previous organizations. Of course, there's no outstanding, but I've left that organization like 4 years ago. But that Amex card is still active. So, should I do anything about it,
you
or
should. I
is it
mean, if you're
okay
not,
to
if
leave it?
because you can't use it, right? So
Yeah,
you
can't
should,
use it.
yeah, you should absolutely remove it. It's having lots and lots of credit cards on your in your wallet is not. I mean, it's not necessarily considered a good thing. The fact that lots of people are willing to give you credit is a good thing, but they also look at how much credit they're giving you, right? So that's another. There's another thing to keep in mind. Just because you have a 1 lakh credit, on a card, doesn't mean you should spend 1 lakh. Just want everybody to make sure they understand that cards give you a limit, which is usually 3 times what they expect you to spend. And but sadly, people think they should spend the whole amount. Should not,
Yeah.
because
And ma'am, in these cases where corporates, are issuing credit card, do we get this close via the organization, or can we reach out to the vendor themselves? I mean, how does that work?
I think you can do both. You can reach out to.
Okay.
It's
Just
easy
both.
to reach out. Yeah, both would work equally well. Either,
Okay.
not both. Either.
My second question, ma'am, is that in the statement I saw there are two more credit cards or credit accounts in my name that I was totally unaware of. There is no overdue, there is nothing, and these are with known banks. And I don't know. I mean,
This is what happens, right? If supposing you make an account with, for example, Cred, right? Cred sells your data. So other loan providers immediately set up an account in your credit in your name, and a credit limit, so that, and then they probably must have sent you an email somewhere saying that we're giving you a credit for a loan up to 1 lakh, etc., etc., and they've set up this in the back end. Don't worry, these are not going to affect your credit score as long as you don't have any balances in them. But it's very sad, but that's exactly what does happen.
oh,
You have to be very
that's
careful who you talk to, who you're sharing your data with. Unfortunately, people think when they get something for free, that it's free, but nothing is free. Companies have to make money, so they're going to make money by selling your data. So don't put things, nothing is free, nothing. So it's, yeah. And that's, yeah, but it's not going to affect you. Don't worry. Having those, you could write to them and say, remove it, or, it's not. I have Lara. Lara, are you on the line? Lara, do you want to talk more about this? So Lara is herself a CA and a CFP and a real investment advisor. Laura? Laura, you're mute.
That's such a relief, ma'am, that you've given to me, because I was really worried
Yeah,
that,
no.
and I've never used any cred for that matter. I get thousands of
Yeah,
advertisements, so I am also very cautious. But
good. You
but
must
in spite
somewhere,
of that,
yeah, in
yeah,
spite of that, exactly. Yeah. It's unfortunate.
yeah,
But it's good that you're just ignoring it. Like a lot of people make the mistake of using it.
Yeah, it's a trap. I mean, when anything which is free means I am the product.
Yes, exactly. That's exactly right. Thank you. That's great. Does anybody have any other questions? Tanvi, you should join me in this. This is awesome.
Yeah, yeah, absolutely.
um, Ritika,
Yeah, I'm here.
I know we've gone way over since we're supposed to have ended 20 minutes ago.
No
So I
worries,
think
but
we
the
did start
session.
late. If Anyway, thank you everybody for joining. Please reach out to us if you have any questions. There is, if you click on the I button in the app, or we can also share with you, Ritika, you could share with them our customer service number and just call it. We're always there during business hours. And Ritika, you can also share my email. So
Definitely.
you can reach out to me directly.
Yeah.
And I would love to talk to your organizations. If you are in HR, I think we can really help your employees. Just like you bring bankers to talk to them to help them open accounts. I'd be happy to be there to just educate them as to how to use these great financial products. Thanks.
Thank you so much, Tanya, for sharing the insights. And I would request all of you to join back on the next Saturday for the day two session, wherein I think, yeah, Tanya will be
Yes.
sharing more
Yes.
insights.
Yes.
Yeah, you guys can join the same link. And yeah, I'm done.
Okay,
Bye.
thank
Thank
you,
you.
Thank you.
Tanya.
Thank you,
Thank
everyone.
you,
Bye bye.
everyone.
Very nice.
Take care.
Very nice.
Bye.